Today we're going to talk about equity funds and debt funds. Investing wisely is a crucial aspect of financial planning, especially in a country like India where economic dynamics are constantly evolving. Among the various investment options available, mutual funds have gained significant popularity due to their diversification, professional management, and accessibility to retail investors. Two prominent categories of mutual funds are equity funds and debt funds. Each serves distinct investment objectives and comes with its set of advantages and risks. In this video, we'll dive into the nuances of equity funds and debt funds and help you make informed investment decisions. Let us begin by understanding the differences between equity mutual funds and debt mutual funds. Equity mutual funds encompass investment in stocks, bonds, and various securities, while debt mutual funds primarily channel investments into debt instruments like government and corporate bonds. Opting for equity mutual funds over debt mutual funds offers several merits. Foremost among these advantages is the potential for superior returns driven by heightened risk associated with equity holdings. Moreover, equity funds typically entail a longer investment horizon compared to debt funds due to the inherent volatility associated with equity investment. Now let us talk about equity funds in detail. The ubiquitous equity mutual funds, often referred to as open-ended equity funds, stand as the prevailing investment choice. These funds offer investors a gateway to participate in both listed and unlisted companies, enabling them to buy or sell equity shares at their discretion. The performance of equity funds hinges on multiple factors, including the fluctuations of underlying stock market indices and the impact of government policies and regulations. Typically, these funds channel their investments towards large cap companies characterized by substantial market capitalization, which is calculated as the market value of a company divided by the number of its outstanding shares. Equity funds are mutual fund schemes primarily focused on investing in company shares or stocks. Under the prevailing SEBI regulations, an equity mutual fund scheme is mandated to allocate a minimum of 65% of its assets to equities and related instruments. While equity funds carry a higher level of risk due to the inherent volatility of the stock market, they are renowned for their potential to yield superior returns, making them an attractive choice for long-term investors. Equity funds can be categorized into active and passive management approaches. In actively managed funds, a fund manager conducts a comprehensive market research to identify stocks poised for best returns. Conversely, passively managed funds assume a more passive role, simply mirroring a designated market index such as the Sensex or the Nifty 50. But before we dive into the world of equity mutual funds, it's crucial to bear in mind several essential factors that can significantly impact your investment journey. Number 1, fund size matters. The size of a mutual fund holds paramount importance as it directly relates to your investment capacity. For individuals looking to allocate a substantial sum, opting for a fund with a sufficient corpus becomes imperative. Smaller funds may struggle to provide attractive returns over time, potentially resulting in subpar investment outcomes. Number 2, evaluating the expense ratio. The expense ratio is a pivotal metric to assess when considering equity mutual funds. It quantifies the fees you pay relative to the value of your investment. A higher expense ratio translates to a more significant proportion of your returns being channeled towards fees. This could erode your profits, making it challenging to generate consistent gains annually. Number 3, balancing risk and reward. Evaluating the risk-reward ratio is crucial when navigating the world of equity mutual funds. This ratio determines how effectively these investments perform over time, compared to alternatives offering comparable returns with lower associated risks. A high risk-reward ratio implies a heightened likelihood of potential losses with limited returns, potentially dissuading investors from pursuing these investments. By keeping these factors in mind, you can make more informed decisions when venturing into the realm of equity mutual fund investments, aligning your choices with your financial goals and risk tolerance. Let us now talk about debt funds. Debt funds, also commonly referred to as bond funds or income funds, are a category of mutual funds that specialize in investments in debt instruments. These instruments encompass a wide range, including corporate bonds, government bonds, money market instruments, and more. What distinguishes debt funds is that the issuers of these underlying debt instruments predetermine both the interest rate and the maturity period, earning them the moniker fixed income securities. Debt funds are recognized for the lower risk profile when juxtaposed with equity funds. Nevertheless, they are not without risks, which are contingent on factors such as the duration of lending and the creditworthiness of the borrower. Debt funds are a prudent choice, particularly for investors who are averse to taking on higher risks. These funds cater to a range of investment timeframes and are available for one, short-term investments, that is 3 to 12 months. Instead of keeping your funds in a traditional savings account, consider investing in liquid funds within the debt fund category. These instruments not only provide the potential for returns in the range of 7 to 9%, but they also maintain liquidity, ensuring that you can access your funds whenever needed. And number 2, medium-term investment, that is from 3 to 5 years. When considering a low-risk investment spanning 3 to 5 years, many tend to opt for bank fixed deposits. However, an alternative worth considering is the dynamic bond fund, which typically offers better returns than FDs over a similar time frame. Additionally, if you require regular monthly payouts similar to FD interest, you can explore the monthly income plan option within the debt funds. Incorporating debt funds into your investment strategy can prove to be a wise decision, aligning well with both your risk tolerance and your specific financial objectives. But before you do that, it's essential to take several key factors into account. Number 1, expense ratio. The expense ratio comprises the total fees associated with the mutual fund, encompassing management fees and additional expenses such as operating costs and transaction fees. Number 2, management fee. A management fee is levied by the fund manager, who is entitled to a percentage of your investment annually. While selecting a fund with an annual management fee might entail higher costs, it can be a worthwhile choice if the fund consistently delivers favorable returns on your investment. And number 3, risk appetite. An investor's risk appetite gauges their willingness to assume risk in pursuit of higher returns. Greater risk tolerance can potentially lead to higher returns, but it's crucial to align your investments with your risk tolerance. If you have a higher risk appetite, you may consider funds with above average return rates or lower expense ratios rather than those with lower returns or higher fees. Both equity funds and debt funds have their merits and demerits. The choice between them should be driven by your financial goals, risk tolerance, and investment horizon. Diversifying your portfolio with a mix of both types of funds can be an effective strategy to balance risk and return. Remember that informed decision making is the cornerstone of successful investing, and staying updated with research from reputable firms like Wright Research can further enhance your financial knowledge and outcomes. This was it for today. I hope we were able to help you understand what equity funds and debt funds are. In case you have any more questions regarding this, please drop them down below in the comment section and we'll reply to all of them ASAP. And if you like this video, please don't forget to give us a big fat thumbs up. We will be back with many more such informative videos. Until then, goodbye and happy investing.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Don't